But coming to the cost of funds, given the kind of balance sheet structure what we have, we guided the market in the past that actually cost of funds will rise by up to 40 basis points. We ended Q4 with a 39 basis point increase, a large part of which we were able to absorb by transmitting increases in the new disbursements. So that's the reason we were able to contain the NIM compression to just 5 basis points, while the cost of funds actually increased by 39 basis points. So we will continue to have the opportunities to transmit the increased rate in the portfolio. So we are very confident of NIM stabilizing in a quarter or two.
Okay, NIM stabilizing in a quarter or two. Mr. Amara, good morning, Prashant here. So just to take that point forward, can cost of funds, is it possible it goes back to 8% kind of levels, pre-COVID levels?
Given the current rate environment, where RBI has also paused and looking for more cues before they take next action, I think we are expecting only 10 to 15 basis point increase further in the cost of funds in the next quarter, whereafter it will stabilize, but the yield will catch up. Already yield has improved by 35 basis points in the last quarter. Yield will continue to catch up. So the NIM compression will be behind us in a quarter.
Mr. Amara, just one more question. While you were at the number 2 place, when one counts the number of cards in force behind HDFC, your share of spending, though, is not keeping pace with the rest of the industry or the leader, for example. And hence, I'm assuming that impacts market share, etc. as well. What can you do to change that?
Spend is a play of both the retail spend as well as the corporate card spends. Retail spends have grown at a very robust pace. 41% is the kind of year-on-year growth what we achieved. While the card base has increased by 22%, the per card retail spends have also increased by 9%. Corporate card spends actually complements the overall spends. It helps in market share. So we do have a calibrated play in this game. But we want to keep the corporate card spends in a narrow range of 22 to 25% of the overall spends, because it doesn't add much to the bottom line. So we will be taking every effort possible to bridge the gap between our SIF market share and the spend share, but we will also be mindful of pursuing a sustainable and profitable growth.
The other thing that the street is a bit worried about is the way the asset quality has deteriorated on a quarter-on-quarter basis. Can you tell us whether there is more pressure that's expected in asset quality, and what is the, what could the gross NPAs look like by the end of the year?
For the record, credit cost for the entire year FY23 is at 5.9%, which is a 230 basis point improvement over previous year. Having said that, Q4 had some different trends where GNPA increased marginally. The credit cost came out at 6.3%. But if we account for one-time kind of changes in the model, which had an impact of around 20 basis points, it was at 6.1%, which is broadly in the range of 5.8 to 6.2%, which we guided in the past. Coming to the analysis of the problem, we did identify a small segment of the portfolio out of legacy portfolio, and that means before COVID, which was exhibiting some higher delinquency. We have taken certain portfolio actions. These will have a positive impact, and the credit cost will trend downwards after a quarter.
Okay, that's on credit costs. But the other two internals, which are also a bit worrying, is that the number of new accounts have gone down 16% compared to last quarter. And the spends per card has also gone down almost 2% on a quarter-on-quarter basis. Now, is it just that, is it a problem specific to SBI Card, or in general is the card industry facing this kind of heat at a time when sort of maybe UPI or other payment portals are doing better? Just trying to understand the dynamics of the market currently, and do you think that there could be more pressure in the new accounts generated over the next few quarters?
I think our new account volume in FY23 was at 5.2 million, which was the highest for us at a 46%, which has also actually helped us gain market share by 100 basis points. Quarter-to-quarter variations, particularly if you're talking about Q4 volume being slightly lower than Q3, was more of a result of some recalibration of the credit filters, which has reduced. But we will always aspire for a 1 million net growth card addition in a quarter. So gross is more like a ways to achieve that, but the objective is to have a 1 million net growth in the cards while keeping an eye on the market share and keeping an alpha above the market growth.
I understand that it's difficult to forecast the revolver share, but it used to be at about 30 to 33% earlier. Should you assume that 30 to 33% is now history and will never, perhaps you never reach that level? What is the possibility over the next couple of years, according to you?
Given the kind of changes that happened, the extent of choices that are available, the extent of competition, and the kind of regulatory guidelines, so I think aspiring for 33% in a very, very short span of time is not possible at all. But if you ask me whether it is going to increase, given the kind of steps what we are taking, particularly when we are going into NTC and NTCC kind of customer segments who are loyal and for whom the credit card is the first time they are using the credit card, there is a possibility of increased propensity of revolving. So we are hopeful of improved or increased revolver, but very difficult to speculate the level at which it will be after a year or two.
All right, Ms. Amara, thank you very much. Great speaking with you. Appreciate you joining in and running us through all of the detail as far as the numbers are concerned. I mean, the market's up a full 3 digits now, 100 plus points in the Nifty, which means we're at the day's high. 18,170 is where we are at. This is, I mean, a nice takeoff from where we left off last Friday. Now, the next corporate to talk to us is CSB Bank. I mean, the company recorded a strong loan growth, especially the non-gold portfolio grew very well. But there was disappointment on the net interest margin front. So let's understand from the management what happened.